Hi everyone, welcome to another session in which we are going to solve some problems about payout policy for the week 4 under the course Financial Management 2. So let's move on. Here we have 5 learning objectives for this chapter. This chapter is from Fundamentals of Corporate Finance 6th edition, written by Briley, Myers and Marcus. So briefly, let's take a look at the objectives. Describe how dividends are paid and how corporations decide how much to pay. Second objective, explain how stock repurchases are used to distribute cash to investors. Third objective, explain why dividend increases and repurchases are good news for investors and why dividend cuts are bad news. Fourth objective, explain why payout policy wouldn't affect the firm in an ideal world. And the last objective, show how differences in tax treatment of dividends and capital gains might affect payout policy. As you remember, we will discuss this in the presentation, course presentation in detail. So this is just to remind you about the objectives, learning objectives. So let's move on. We selected some problems for you to solve. The first problem is about splits and dividends, which is linked to learning objective 1. So let's take a look. Shares in Raven products are selling for $80 per share. There are 1 million shares outstanding. What will be the share price in each of the following situations? Ignore taxes. So we are going to ignore taxes. So A, the stock splits 5-4-4. So split, if you remember, let me just draw this. 5-4-4, this means in the new case 5 shares will be equal to 4 shares. So in other words, we are going to split shares by this ratio. How to treat this? Well, the price is here is $80, and if we multiply this by a factor of 4 to 5, that means we are going to find $64. Now do not forget, in case of splits, the new price will be lower than old price. So in this case, old price is $80 and new price is $64. We also have reverse split situation, and in that situation we have the reverse case. In that case, new price will be higher than the old price. So in this case, let's take a look to B and express our feelings about these concepts in more detail. The company pays a 25% stock dividend. Well, in that case, the stock price, which is 80 stock price, will fall by a factor of 1.25. It is because now we are going to distribute 25% stock dividends, which means per each stock we are going to pay 25% of stock. So this makes 1.25 factor. So if this is the case, then $80, which is a price, old price of the stock, I should divide this by a factor 1.25, so I will get exactly the same result as we found in A. Here, 64. So why this is the same? Why this is the same? Let me now explain in more detail. If you pay attention to this argument here, if you pay attention to the argument here, let me erase this part here. This is written in 5 to 4. If you divide 5 by 4, you will find 1.25. That's why here, which is 1.25, that's why we have the same result as we found here. So see, the company repurchases 100,000 shares. So in that case, will the price remain the same? This is the question. In this case, we shouldn't forget that a share repurchases will have no effect on price per share, That's why $80 per share will remain the same. Okay? So stock repurchases does not affect price of a share. So let's move on. The next one, you can take a look at the solution here. So we have another problem. So let's see, it's about cash dividend. But the stock of Payout Corp will go ex-dividend tomorrow. The dividend will be 50 cents per share, and there are 20,000 shares of stock outstanding. The market value balance sheet for payout is shown on the following table. So A, what price is payout stock selling for today? B, what price will it sell for tomorrow? Ignore taxes. So today price A, today price, if you remember, price, or let me write in the other way, market value of a company is equals to price of share, price times number of shares. From this equation, you can find the price for today. Now you have 20,000 share. You don't know the price. And the market value is here. the market value. If you don't have the market value, you should treat equity as a candidate for market value. So this is 1 million. So price from here is $50 per share. So C, X dividend day, well, the result will be simply the difference between price and dividend per share. So for this reason, price tomorrow will be price today minus dividend, cash dividend. This is cash dividend, do not forget, per share. So 50 minus 0.50 will be $49.50 per share. Do not forget we ignore taxes. Well, we will see the impact of taxes in the forthcoming problem. So this is your solution. So here we come to another problem. Dividend and taxes. Now we will see the impact of taxes on stock price before and after dividend payment. So good values include is all equity financed. The total market value of the firm currently is $100,000 and there are 2,000 shares outstanding. Ignore taxes. So what is asked in A? The firm has declared a $5 per share dividend. The stock will go ex-dividend tomorrow. At what price will stock will sell today and tomorrow? For today, we learned from the previous problem, we will divide market value by number of shares, which is $100,000 divided by 2,000 shares, which is 50. So tomorrow price, we learn from the previous problem, price today minus dividend, cash dividend per share. So $5 per share, which means 50 minus 5, which is 45. If I ignore taxes, do not forget please, if I ignore taxes. So at B here, part B, it is asked that what will happen if there is 30% dividend income tax rate on dividend income. So first you should calculate your tax over your income, dividend income. This $5 is your dividend income, and your tax over this income will be 30%. You need to pay this $1.5 will be tax, should be paid. What will be remain? 5 minus 1.50, $3.50 will be left. As after tax dividend income. For this reason, price for tomorrow price will be price today minus adjusted dividend per share. So we are going to find just a second. in this first, let's find price today first of all. All right, now here let me first rearrange this. Okay, so what is asked now? Assume that the tax rate on dividend income is 30% and tax rate on capital gain is 0. At what price will the stock sell, taking account of the taxation of dividends? So this is the amount of tax you should pay, and this is the amount of income you are going to gain after tax adjustment. So what is asked over here is what is the price today? In any case, price tomorrow here will be the same as this one, but price today will not be equal to 50. It is because there will be $1.50 per share tax adjustment. So price today will be equal to 50 minus 1.50, which is the tax per share. So price today should be equal to 48.5 here. So okay, this is done. Just a second. This is your formal solution. You can stop video and check this out. Okay, so our last problem, this is about repurchases and taxes. What is repurchase? Simply speaking, firms time to time may buy back its own shares from the market. So as a result, they decrease the number of shares, they reduce the number of shares circulated in the market. Alright, this is what repurchase is, and let's take a look what is asked. Now suppose that instead of paying dividend, good values from the previous example, plans to repurchase $10,000 worth of stock. So A, what will be the stock price before and after repurchase? We learned that in the first problem, we said that repurchases does not affect the price. So let's see how this takes place. First of all, here the repurchase, that's the general rule in US. The repurchase will have no tax implication. Because the repurchase does not create a tax obligation For the shareholders, the value of the firm today is the value of the firm's assets. Here assets is $100,000 worth. From the previous case, we know this. Divided by 2,000 shares. 2,000 shares or $50 per share. The firm, what it says here, the firm will repurchase 200 shares for $10,000. Okay, so after this repurchase, after the repurchase, the stock will sell at the price of $90,000 divided by 1,800 shares, which is equal to exactly to $50 per share. So the price is the same as before the repurchase. So maybe you want to learn how we come to that point. From this point, how we come to that point. So market value of the company before repurchase was $100,000, and in that case the number of shares was 2,000 shares. So price in this case will be $100,000 divided by 2,000 shares, which is $50. After repurchase, firm spent $10,000 for buy back 200 shares. So what will be left in the company as an asset, as an equity? So $90,000 will be left because we spent $10,000 here. So since we take 200 shares out of the market, so how many shares will be left in the market which can be sold and bought by investors? So if we take 200 out of the market, so we are going to have 1,800 shares left in the market. Okay, so the result will be again the same. So one may ask, this is a very technical question. You may ask that the firm bought 200 shares. So what will happen to these 200 shares? There are two alternatives. At the first alternative, it may be cancel the shares. The second alternative, they may restore in company balance sheet, as treasury stock. But be careful, treasury stock, for treasury stock, there should be a cost in equity section. So this cost will be negative figure in the equity. That's why, although you are going to see treasury stock in balance sheet, it will have negative sign. All right. B. Let's take a look to B again. Suppose an investor who holds 200 shares sell 20 of her shares back to the firm if there are no taxes on dividends or capital gains. Show that she would be indifferent between the repurchase and the dividend. So let's try to understand this problem here. This is B. An investor who owns 200 shares and sell 20 shares to the firm will receive 20 shares times $50, $1,000 cash in cash. This investor will be left with will be left with 180 shares worth $9,000. 180 times 50, $9,000. So the total value of the investor position is $10,000. So in the absence of taxes, if there's no taxes, this is precisely the cash and share value that would result if the firm paid a $5 per share cash dividend. Cash dividend. Cash dividend. If the firm had paid the dividend instead of this, the dividend, the investor would have received a cash payment of 200 shares. Remember, investors had 200 shares times $5 dividend per share, which is equals to 1,000. Okay, and remember, in this case, investors didn't sell any shares but received $5 dividend per share. How many shares this investors has? Still 2,000 shares. But in this case, share price will be 45, not 50, because 5 cash dividend is paid. And from this equals to be $9,000. So 1,000 plus 9,000 will be equal to $10,000, which is exactly the same. Okay. So we prove that we have the same situation for this investor. So last one, show that if dividends are taxed at 30% and capital gains are not taxed, the value of the firm is higher if it pursues the share repurchase instead of dividend. Let's prove this. Okay. See, we compute the value of the shares once the firm announces its intention to repurchase shares or to pay a dividend. If the firm repurchases share, then today's price is $50, and the value of the firm is $50 times 2,000 shares if they pay dividend or repurchase will be equal to $100,000. If instead the firm pays a dividend then the with dividend stock price is 48.50 $50. Why 48.50? Remember that tax rate was 30%, so if they pay 5% dividend per share, let me write here, over $5 cash dividend, tax amount is this, so this will be equal to $1.50. So this should be substituted from the today price, which is 50. That's why we have 48.50. So the value of the firm is only $97,000. Well, why? Because this is $3,000 less than the value that would result if the firm repurchased shares. The $3,000, where this come from? $3,000 difference represents the taxes on the $10,000 in dividends. Well, $5 cash dividend per share over 2,000 shares will be equal to $10,000. Okay? Alright guys, we come to the end of another session. Here you can stop the video and see the results for the last problem. Okay, thanks for watching and see you in another session. Bye.